Is rising debt always a bad sign? Occidental Petroleum's massive CrownRock acquisition has spiked its debt, but could this be a strategic masterstroke? Join us as we uncover how this move, plus advances in carbon capture technology, might position Occidental for long-term growth despite market volatility. Discover the surprising strategies shaping Occidental's future. Occidental Petroleum is a leading U.S. oil and gas producer with significant operations in the Americas and Middle East. Its strategic acquisitions have expanded assets but increased debt, influencing its financial health for value investors. Occidental's balance sheet shows a significant increase in total debt, rising from $20.82 billion in June to $27.65 billion in September 2024 due to the CrownRock acquisition. The debt-to-equity ratio climbed to 0.79, just below the 0.8 threshold, indicating higher leverage but still within acceptable limits. Retained earnings increased to $21.69 billion, reflecting strong profit retention. Modest growth in Treasury stock buybacks aligns with the company's commitment to return value to shareholders, highlighted by $606 million in dividends. However, the negative cash-to-debt position and substantial preferred stock suggest some financial risk. Overall, Occidental demonstrates solid profitability amid increased debt levels. Here's a screenshot of the full balance sheet. Notably, the current liabilities are slightly up, indicating increased short-term financial obligations. However, the substantial rise in long-term debt suggests a strategic investment. Equity growth despite Treasury stock reduction reflects underlying strength. These elements underscore Occidental's potential resilience and opportunities for value investors. Occidental's recent income statements show a mixed financial picture. The gross margin has improved, rising from 32% to over 38%, reflecting enhanced cost efficiency, though still shy of the ideal 40%. However, the net income margin has dipped from 17% to around 16%, impacted by higher interest expenses due to new debt and weaker performance in the chemicals segment. Despite lower crude oil prices, the CrownRock acquisition has bolstered sales volumes, partly offsetting revenue declines. Operational cost control is evident with SG&A margin reducing to 3.74%. Yet the decline in EPS growth is a concern. These factors present both challenges and opportunities for long-term value investors. Here's a screenshot of the full income statement. Notably, there is a decline in net income for the quarter compared to last year, influenced by increased interest expenses. This could indicate potential risk areas in debt management, but also opportunities if costs are well managed, aligning with value investing principles. The cash flow statement shows significant swings in Occidental's free cash flow over the past year. After dipping to $275 million in March 2024, it surged to $2.02 billion by September 2024. This rebound indicates improved cash generation despite lower crude prices, likely due to strategic timing of sales and operational adjustments. However, the capex margin remained high, peaking at 195% in March 2024, reflecting substantial investments like the CrownRock acquisition to expand production capacity. Notably, stock-based compensation dropped to zero in recent quarters, suggesting a shift in remuneration strategies to conserve cash for strategic investments. Here's a screenshot of the full cash flow statement. Occidental's robust $8.08 billion net operating cash flow shows strong operational efficiency. Yet, significant investing cash outflows highlight aggressive expansion strategies, posing liquidity risks. Positive $5.05 billion from financing indicates confidence but suggests rising leverage. Understanding these dynamics is crucial for evaluating Occidental's long-term value potential amidst volatile market conditions. Occidental's financials show resilience amid market volatility. After revenues dipped to $5.97 billion in March 2024, they rebounded to $7.17 billion by September, thanks to the CrownRock acquisition and strategic production adjustments. Net income followed suit, but saw a slight decrease from $1.16 billion in June to $1.13 billion in September, impacted by higher interest expenses and lower margins in some segments. Management's cautious optimism and focus on operational efficiencies suggest the company is adeptly navigating market challenges. However, increased interest expenses and lower margins highlight areas to monitor. Overall, Occidental's strategic actions may strengthen its long-term value proposition. Occidental's market cap trails larger peers like COP and EOG, reflecting its smaller market share. However, strategic growth initiatives and operational efficiencies may help narrow this gap, enhancing its competitive position in the sector. Occidental's DCF valuation reveals intrinsic value fluctuations versus market price, highlighting periods of mispricing due to commodity volatility and market sentiment. Management focuses on strategic investments and sustainability to realign market perceptions with intrinsic worth. Occidental's valuation metrics closely match industry peers, highlighting a competitive stance. Strategic expansion and operational efficiency may boost earnings, but oil price volatility remains a key risk. Analyst forecasts suggest Occidental's stock could range between $57 and $77 in the next year. Strategic operational focus may enhance value, but oil price volatility and geopolitical risks remain key considerations. Occidental Petroleum's latest earnings call revealed a notable decline in net income compared to the previous year, primarily due to lower oil and gas prices. Despite the reduced earnings, the company continued to strengthen its balance sheet by aggressively paying down debt. Management emphasized their commitment to disciplined capital allocation, focusing on high-return projects and shareholder value through dividends and share repurchases. Importantly, Occidental is advancing its carbon capture initiatives, positioning itself as a leader in low-carbon technology, which could offer significant long-term growth opportunities. The company's strategic focus on debt reduction and investment in sustainable technologies suggests potential for enhanced value creation. However, the dependency on volatile commodity prices remains a risk factor to monitor. Occidental Petroleum's strategic acquisitions and robust cash flow present compelling opportunities for value investors. Despite increased debt from expansion, the company's focus on operational efficiency and debt reduction initiatives indicates potential for long-term growth. Investments in carbon capture technology position Occidental at the forefront of sustainable energy. While commodity price volatility is a risk, the fundamentals suggest a promising outlook. For more expert analyses, subscribe, like, and share. Join our community and explore more insights in the next video.